Ever wondered how big companies like Apple or Tesla decide where to get their money from? Do they just print more shares, take out a huge bank loan, or do they have a secret stash of cash somewhere? Well, there's a fascinating idea in finance called the Pecking Order Theory, and it explains this exact process in a really simple way. Stick around and I'll break it down so you can sound like a finance pro at your next dinner party. So, what is this pecking order? Imagine a group of chickens. The strongest one eats first, then the next strongest, and so on, right down to the weakest. Companies, according to this theory, do something similar when they need cash. They have a preferred order for getting funds, a financial pecking order. At the very top of this order, the first choice is internal financing. This is the company's own money, the profits they've saved up over time, also known as retained earnings. Why is this number one? It's simple. It's the cheapest, fastest, and easiest way to get cash. There are no loan applications, no interest payments to a bank, and no need to convince skeptical investors. The company's management is in full control. They don't have to answer to anyone or give away a piece of the company. It's like using your own savings to buy something instead of borrowing from a friend. It's just less hassle. But what if the company needs more money than it has in its savings? Maybe they want to build a giant new factory or launch a groundbreaking product. That's when they move to the second choice in the pecking order: debt. This means taking out loans from banks or issuing bonds. Now, why is debt preferred over the next option? Taking on debt is less complicated and sends a better signal to the market than the final option. When a company takes on debt, it shows confidence. The managers are basically saying, "We believe in our future projects so much that we're willing to promise to pay this money back, with interest." It signals that they expect strong, steady profits. Plus, they still don't have to give up any ownership of the company. The original owners keep their full stake. Now we get to the last resort, the bottom of the pecking order, issuing new equity. This means selling new shares of the company to the public. Why is this the least favorite option? A couple of big reasons. First, it's expensive and complicated. There are a ton of legal fees, and you have to go through a whole process to sell these new shares. But more importantly, it sends a really bad signal to investors. Think about it. If the company's own managers, the people who know the business inside and out, are willing to sell off pieces of it, what does that say? It might suggest they think the company's stock is currently overpriced. It creates what we call information asymmetry. The managers know more than the public, and the public gets suspicious. This can cause the stock price to drop, which is the last thing a company wants. Plus, selling new shares dilutes the ownership of existing shareholders. Their slice of the pie just got smaller. So, let's recap the pecking order. First, use internal funds, the company's own cash. If that's not enough, take on debt by getting loans or issuing bonds. And only as a final, last-ditch effort, sell new shares of the company, which is issuing equity. This simple hierarchy helps explain why we see profitable, mature companies relying heavily on their own profits, while younger, fast-growing companies might have more debt. It's a practical and logical way that many firms approach their financial strategy. It's all about minimizing costs and sending the right signals to the market. So the next time you hear a company is raising money, you can ask yourself, where are they getting it from? Are they using their own cash, taking on debt, or selling new stock? Now you know what each of those choices might mean about the company's health and its leaders' confidence. I hope this breakdown of the pecking order theory was helpful. If you enjoyed this and want to learn more cool concepts from the world of business and finance, make sure to hit that like button and subscribe to the channel. Thanks for watching, and I'll see you in the next video.